Harold opened his January Medicare statement and stared at it for a full minute. His Part B premium had jumped from $185 a month to nearly $400. Nothing about his health coverage had changed. Nothing about his age had changed. His Social Security benefit had gone up with the annual cost of living adjustment, yes, but this was something else entirely. Harold, a retired mechanical engineer from Pittsburgh, Pennsylvania, called Social Security and eventually reached a representative who explained in flat, bureaucratic tones that his 2024 tax return had shown modified adjusted gross income just over the $133,000 threshold, triggering the second tier of what Medicare calls the Income-Related Monthly Adjustment Amount, or IRMAA. Harold had sold some appreciated mutual fund shares in 2024 to help his daughter with a down payment on a house, creating a one-time capital gain. That single transaction, well-intentioned and completely legal, had triggered a surcharge that would cost him approximately $2,600, on top of his standard premium for the entire year of 2026, the most painful part. The surcharge was temporary, would drop off the following year, but the cash was gone, and nobody had warned him. Most retirees do not understand how these income-based Medicare surcharges work until they get the letter, and by then the tax year that triggered it is often years behind them with no way to recover. If you are approaching Medicare age, or you're already on Medicare with fluctuating income from retirement accounts, part-time work, or investments, this is one of the most important income planning concepts you will ever encounter. This video is for educational purposes only and is not personalized tax, financial, or legal advice. Consult a qualified professional for guidance on your specific situation. Now, let us walk through the IRMAA framework in detail, because once you see the thresholds and the mechanics, you can plan around them with precision. IRMAA stands for Income-Related Monthly Adjustment Amount, and it is the federal government's mechanism for charging higher-income Medicare beneficiaries additional premiums for Parts B and D. The theory is straightforward. Medicare beneficiaries with higher incomes can afford to pay a larger share of the program's cost, so the federal government tiers premiums based on income. The practice is more complicated than the theory because the income calculation uses a specific definition called Modified Adjusted Gross Income, or MEGI, which includes your AGI plus any tax-exempt interest, plus other items depending on your specific situation. And the income is measured 2 years in arrears. Your 2026 IRMAA is based on your 2024 tax return. Your 2027 IRMAA will be based on your 2025 return, and so on. Here are the 2026 thresholds for reference, and these adjust annually with inflation. For single filers, the first IRMAA tier begins at modified adjusted gross income above $106,000. The second tier begins above $133,000. The third tier begins above $166,000. The fourth tier begins above $200,000. The fifth and highest tier begins above $500,000. For married couples filing jointly, all those thresholds are doubled. The first tier begins at $212,000, the second at $266,000, and so on, with the highest tier beginning at $750,000. The surcharges rise significantly at each tier. For Part B, in 2026, the first tier adds approximately $74 a month to your standard premium. The second tier adds around $185 a month. The third tier adds around $297. The fourth tier adds around $409. The fifth tier adds roughly $446 over a full year. That means the first IRMA tier costs a single retiree approximately $885 a year extra. The second costs $2,200. The third costs $3,500. The fourth costs $4,900. And the fifth costs over $5,300. For a married couple, every person on Medicare pays their own IRMA separately, which doubles the impact. There are also Part D IRMAA surcharges, which apply on top of whatever Part D premium your specific drug plan charges. The Part D surcharges range from about $13 a month in the first tier to over $85 a month in the highest tier. Added to the Part B surcharge, the total monthly IRMA for a retiree at the top tier can exceed $530 a month or $6,400 a year. For a couple, both at the highest tier, that is over $12,800 a year in income-based premium surcharges alone. The cruel mechanic of IRMA is the cliff structure. It is not a gradual phase-in. Every threshold is a hard step. Cross $1 over the first threshold, and you pay the full first-tier surcharge for 12 months. Cross $1 over the second threshold, and you pay the full second-tier surcharge for 12 months. The system does not prorate. A single dollar of additional income at the wrong level can cost you hundreds or thousands of dollars in extra premiums. This is what makes IRMA planning so specific and so valuable. Retirees who understand where the thresholds sit can often manage their income to stay just under a cliff, saving themselves significant money with minimal practical impact on their lifestyle. Joyce, a retired hospital administrator from Columbus, Ohio, watched her 2024 income carefully in the final weeks of December. She had pension income, a small part-time consulting arrangement, Social Security, and RMDs from her traditional IRA. Running the numbers in early December, she saw that her projected MAGI for the year was approximately $107,000, roughly $1,000 over the first IRMA threshold. Crossing that threshold would cost her $885 in extra Medicare premiums when 2026 arrived. The fix. She made a $5,000 qualified charitable distribution to her church directly from her IRA, which reduced her taxable income by $5,000, dropped her firmly under the RMA threshold, and preserved the $885. Net benefit of her December planning move, roughly $900 on a gift she was planning to make anyway. That is the kind of value hidden inside RMA awareness. Let me walk through the key planning strategies now. Strategy 1. Manage realized capital gains carefully in years where you're close to an RMA threshold, a sale of highly appreciated stock, a rental property, or mutual fund. Shares can trigger a one-time spike in MAGI that crosses multiple thresholds. If you are planning a significant sale, run the RMA projection before executing. Sometimes, splitting a sale across 2 calendar years reduces the total RMA impact dramatically. Other times, offsetting a realized gain with a realized loss through careful tax loss harvesting can keep you under a threshold. Strategy 2. Use qualified charitable distributions, as I mentioned, for any charitable giving if you are 70 and a half or older and have a traditional IRA. QCDs reduce MAGI dollar for dollar, preserving your IRMA tier. Strategy 3. Consider the timing of Roth conversions against the IRMA 2-year lookback. A Roth conversion executed in 2026 will affect your 20 to 28 Medicare premiums. Know that going in and plan for it. Many advisors suggest doing conversions in years when you are already committed to being at a higher IRMA tier because the marginal cost of additional conversion dollars within the same tier is zero. If you are already paying the third tier surcharge, converting additional amounts within that same tier does not increase your IRMA further, provided you stay under the next threshold. This is a useful planning insight for retirees doing multi-year Roth conversion ladders. Strategy 4. If you experience a qualifying life-changing event, request a new IRMA determination using Form SSA 44. Life-changing events include marriage, divorce, death of a spouse, work stoppage, work reduction, loss of income, producing property, loss of pension income, and an employer settlement payment. The Social Security Administration will recalculate your IRMA based on your current income rather than the 2-year-old return. This is particularly valuable in the first year after retirement, when your current income is dramatically lower than your last full working year's income. Without Form SSA 44, Medicare will base your premium on your 2-year-old return, potentially charging you a surcharge based on income you no longer earn. Many retirees overlook this form and overpay for 2 years before RMA naturally adjusts to their lower retirement income. Strategy 5. Coordinate spousal income planning. If one spouse is still working while the other has retired, a married filing jointly return combines both incomes for IRMA purposes. Sometimes, in specific circumstances, filing separately can reduce IRMA for the retired spouse, although filing separately triggers other tax consequences that often more than offset the IRMA savings. This is a conversation for a qualified tax advisor because it depends on the specifics. Strategy 6. Time large. Discretionary income events like Roth conversions, large 401k withdrawals, or capital gains realizations in calendar years where you accept the IRMA hit deliberately. For example, if you are selling a rental property with a substantial capital gain, you know that year is going to be a high income year regardless. That is often the most efficient year to execute a larger Roth conversion because the marginal IRMA cost of the additional income is already paid through the capital gain realization. Arthur, a retired electrician from Houston, Texas, used this exact strategy in 2024. He sold a rental house for a $250,000 capital gain. That year, his MAGI was pushed into the third IRMA tier. Rather than viewing the year as a tax disaster, he took advantage of the fact that he was already at a high tier and did an additional $40,000 of Roth conversions within the same tier. The marginal IRMA impact was zero because he did not cross into the fourth tier. The additional conversion dollars paid only the ordinary federal income tax at his marginal bracket, with no further IRMA penalty. He used a bad tax year to do efficient work. The following year, his income dropped dramatically. IRMA dropped back to the standard premium, and the Roth balances he created continue to grow tax-free. Now let me walk through the SSA 44 form specifically, because it is one of the most valuable and least used tools available to Medicare beneficiaries. The form is formally titled Medicare Income-Related Monthly Adjustment Amount, Life-Changing Event. It is 2 pages long. You complete it, attach proof of the life-changing event, such as a retirement letter, death certificate, or divorce decree, and submit it to your local Social Security office. They review it, recalculate your IRM-AA based on current year income, and issue a new determination. If you are approved, the new premium takes effect prospectively, sometimes retroactively, depending on the specifics. The form is critical for the year of retirement and any subsequent year where your income drops significantly due to a qualifying event. Do not wait for Social Security to figure it out on their own. They will not. You must request the review. Ruth, a retired librarian from Lincoln, Nebraska, filed her SSA 44 in February of the year after she retired. Her 2023 tax return, on which her 2025 RMA was based, showed $98,000 of income from her final year of working. She actually retired in December 2023. Her 2025 income was only $62,000, all Social Security and small RMDs. Without the form, she would have paid the first tier IRMA for all of 2025 on income she no longer earned. By filing SSA 44 with her retirement letter attached, she had her 2025 RMA waived entirely, saving her $800 and some for the year. Let me also address the common mistake of tax-exempt interest. Many retirees invest in municipal bonds or municipal bond funds for their tax-free interest, assuming it has no impact on their income picture. For federal income tax, the interest is indeed exempt. But for Medicare RMA calculations, tax-exempt interest is added back into MAGI. That means a retiree with significant municipal bond holdings can cross an RMA threshold, even though the income is not taxable at the federal level. This is one of the most common surprises in IRMA planning. If you own muni bonds or muni bond funds in any meaningful amount, run your IRMA projection with and without the tax-exempt interest to see whether it is pushing you into a higher tier. 3 traps to avoid. First trap. Do not assume that because your income is lower this year, IRMA will automatically drop. It adjusts on a 2-year lag, unless you file Form SSA 44 for a qualifying life-changing event. A simple drop in investment income from market performance or a business slowdown is not a qualifying event. You must wait for the 2-year cycle to catch up. Second trap. Do not forget that Roth IRA withdrawals and qualified Roth distributions do not count toward MAGI for IRMA purposes because they are not included in adjusted gross income. This is a major advantage of having built Roth balances before reaching Medicare age. Every dollar you spend from a Roth IRA in retirement is IRMA neutral, while every dollar from a traditional IRA is IRMA relevant. Third trap. Do not appeal an IRMA determination based only on disagreement with your income. You can only successfully request a redetermination in 2 scenarios. Either a qualifying life-changing event has occurred or the tax return data Social Security is using is incorrect. If Social Security is using accurate 2-year-old tax data and no life-changing event has happened, there is no appeal path. Your best tool is proactive income management in the current year. Let me now do the consolidated math on why this matters so much. Suppose you are a married couple, both on Medicare, with combined modified adjusted gross income that hovers right around the second IRMA threshold of $266,000. In a good investment year, you trigger the second tier. In a bad year, you trigger only the first. The difference between tiers for both spouses, Part B plus Part D surcharges included, is approximately $3,200 for the year. Over a 20-year retirement, thoughtful management of income to stay at the first tier instead of the second, even for half the years, saves roughly $30,000. Stay at the standard premium with no surcharge for most of your retirement, and the savings climb well beyond that. These are not small numbers for any retired household, regardless of how much they have saved. The most important action you can take is to run your RMA projection every October and November, using your projected MAGI for the current year and the published next year thresholds. Compare your projected MAGI to the cliffs. If you are close to a threshold, identify specific moves before December 31st. Options include QCDs, deferring income if possible, accelerating deductible expenses, realizing capital losses to offset gains, and adjusting the timing of Roth conversions or large withdrawals. Small end-of-year moves have outsized impact when they prevent a threshold crossing. If you have already been hit with an IRMA surcharge and you believe it is based on outdated income, pull out Form SSA 44, confirm you have a qualifying life-changing event, and file promptly. Do not wait. Do not assume it will resolve itself. And if you're approaching Medicare age, build IRMA awareness into every income decision you make during your first decade of retirement because this is the decade where your choices have the biggest compounding effect. One additional consideration that rarely gets mentioned. IRMA applies to each Medicare beneficiary individually, but the income measurement is based on your joint tax return if you file jointly. That means both spouses on Medicare pay IRMA based on the combined household income, which effectively doubles the premium impact of crossing a threshold. For a married couple, both on Medicare, a single threshold crossing can generate surcharges for two beneficiaries, making the combined annual cost significantly higher than the per-person surcharge might suggest. Keep this in mind when planning end-of-year moves. The household impact is always greater than the individual impact for couples on Medicare together. Another nuance worth knowing, the IRMAA thresholds are adjusted for inflation each year, but the adjustment is typically modest and often lags actual inflation. Retirees whose incomes rise with COLA and normal retirement account growth can find themselves creeping into higher tiers over time, even without making any active income decisions. Building IRMA awareness into your annual planning, rather than treating it as a one-time check, is essential for retirees who want to preserve their Medicare cost structure across a multi-decade retirement. If you want a specific walkthrough of the SSA 44 form, line by line, with sample answers for common life-changing events, leave a comment below with the letters SSA, and I will make sure that video gets in front of you. Subscribe so you catch the rest of the Medicare planning series, including the upcoming deep dive on Medigap plan selection and the difference between Medicare Advantage and Original Medicare in high cost of care states. Take good care of yourself and your income, and I will see you in the next video.